Hi everyone, Jackie Zerbe here, mortgage broker with Verico Total Mortgage from Vancouver, BC, and I'm here chatting with Christine Kopr from Sotheby's Realty today.
Hey everyone, thanks Jackie so much for having me with you today. Looking forward towards this chat. Can't wait to get your insights on today's quarter point rate decrease from the Bank of Canada. So looking forward to explaining how that impacts variable rate mortgages versus fixed mortgages and some of the things that people need to consider right now because these are very interesting times. It's never a dull moment here in Canada, is it? I think you had some information that you wanted to share with us today, so let's take a look at that.
This kind of gives you a breakdown of back in the early 80s where rates were at based on 1 year, 3 year, 5 year fixed rates, and then prime. And this was the last 10 years before COVID. So this is the normal interest rate range, like hovering in the three, fours, and fives, right? You can see that. But then if we
Yep.
zoom into the last 10 years pre-COVID, you can see a breakdown like back when we had the subprime meltdown in 2008, governments worldwide had to reduce their costs of borrowing in order to stimulate economies worldwide. So you can see as a consequence, interest rates came down, right? And then things were pretty groovy for about 10 years or so. This was the normal interest rate range. And then in 2020, we had COVID, which was a black swan event. So again, economies worldwide had to be revived. So central banks had to reduce their overnight lending rates, which then made the cost of borrowing cheaper. So this is where we saw those nice low mortgage rates. But then in the background, inflation started creeping up because there was supply chain issues and suddenly things got out of control. So then we saw the Bank of Canada start to increase their overnight lending rate. And that's where we had that huge shock to our systems in 2021, 2022, where we saw prime increase more than 4%, right? And then inflation started to behave itself again and is now approaching that 2% target range. And consequently, the Bank of Canada has started decreasing their overnight lending rate. So now we're seeing things are coming back to normal, and it's
Excuse me.
it's to be expected that fixed rates are going to be in the 4 to 5% range, which, if you can see, it's kind of where things were at pre-COVID. Now, what's interesting is that people that had these awesome low rates in 2020 and 2021, they locked in for 3, 4, or 5 years. All of those clients are coming up for renewal this year and next year, and they're expecting rates at 2 and 3% because that's what they've been used to having the last 3, 4, 5 years. However, those are not normal rates. Normal stable rates are in the 4 to 5% range. So I'm mentioning this because there's going to be a bit of payment shock for people that are coming up for a renewal, right? So just a bit of a history lesson to kind of have a reality check to see what to expect in terms of rates. In terms of bond deals, so as we know, the Bank of Canada today decreased their overnight rate, which is going to directly impact the prime interest rate. We're going to move from 5.45% down to 5.2%. If you have a variable rate mortgage or a line of credit, you're singing hallelujah again because your cost of borrowing is lower. If you have a fixed rate mortgage, your payment's not going to change. Today's Bank of Canada announcement directly impacts variable rate mortgages and lines of credit. Fixed rate mortgages are not going to change. Now, what does drive fixed rate mortgages is the bond market. And you can see over here today, the bond market's been pretty stable because they've already priced in the Bank of Canada's um, decrease in their overnight lending rate. Now, this is just today's snapshot, and we're only halfway through the day. If you look at the last 6 months of the bond market, you can see that it's been extremely volatile. Okay. And volatility is the name of the game for 2025. There's so much uncertainty with respect to the new administration in the States. and things can change daily. So it's really important to align yourself with a mortgage professional that keeps track of what's going on in the market.
Very cool. Well, I'm glad that you brought that up because look at the bond market there, which dictates fixed rate mortgages, as you mentioned. And man, that kind of sucks if you were in like January, things are a little bit higher. Um, well, if you were going for a mortgage at this point in time, the fixed rate was a little bit higher. Question for you. Have we seen changes in the fixed rates in these last few months, or have they been holding relatively steady, or what's been happening there?
Fixed rates have been holding relatively steady for the last couple months. And there are some great deals to be had right now. And if you currently have a fixed rate mortgage above 5.2%, then it's worthwhile reaching out to your mortgage broker to see if it makes sense to break your mortgage term early because you could potentially be leaving thousands of dollars on the table. So right now there's some great rate specials and they're much better than they were 6 months ago and even 9 months ago. So it's definitely worthwhile to do a check-in with your mortgage professional just to see where you're at. In terms of variable rates, I always like to show this slide because it's always fun playing the prediction game where the major banks put out their forecasts and predictions. So this was issued back in December, and you can see what the banks were predicting was going to happen for the first quarter of this year. And then you'll see the second and third and fourth quarters. So what's interesting to note is that Scotiabank believes there's only going to be 1/4 point drop this year, which happened today. So they're the most conservative out of the big six banks. The rest are kind of all over the place. Now, it's interesting that RBC is predicting a full 1.25% drop in prime for this year. To me, that's quite aggressive, but apparently they hold a different crystal ball than others. So this is always just worthy of a chat to see where banks think rates might be headed. Obviously, nobody holds a crystal ball. As I said, things are volatile, so we shall see what happens.
Interesting times, interesting times. Any other interesting things you want to share with people today? Because the new administration and the threat of tariffs, which I mean, are obviously a negotiating tactic, but they are real, right? And they're negotiating towards something, maybe tighter borders and better security and less fentanyl in the streets. But hey, don't sound so bad to me. Not sure what's wrong with them in the first place or those requests in the first place. But anyways, I digress. Recognizing that's a legit thing and, as evidenced as President Trump's action on Colombia, where he was sending a plane load of illegal immigrants from their country back home and they refused. And then he instantly threw on the tariffs and instantly did that. And luckily that president decided president of Colombia decided to receive their immigrants or their migrants. So clearly there's a chance that we're going to have tariffs. And it is an interesting landscape because I truly believe in my heart of hearts, I hope is maybe the better thing to say that eventually once we no longer have a prorogated government and the people actually get to elect their leaders and we elect a new leadership in this country and we work on I don't know, having a safer country, safer borders, less drugs on the street, and see what kind of decisions the US are making. And if Canada decides to follow along, I mean, we could be in such great shape. Like we can be great again, like we were back in the, 2000s. And when we embraced all the things that we are, which is a resource-based economy that exports to other nations. And we decide to, diversify our markets and do all the things that this country has been wanting to do for a really long time, but then kind of lost focus and focused on some other things and forgot about that. That's like a really critical piece too. And you can maybe do some of those things aligned at the same time. Anyways, but if things go the other way, things could actually be really shaky. I think there's a lot of concerns out there about this country going into a deep recession if we don't play our cards right. So two questions. One is, are you getting more phone calls and people being more interested in the market right now? And number two, is there any sense of people being concerned about their job security or potential recession from the conversations you're having?
Absolutely. So to answer your first question, absolutely, I'm getting more phone calls. I've never had a busier January in the 17 years that I've been brokering, and that's quite strange because usually November, December, January are kind of slower months when it comes to people buying. But the last few months, there's been a ton of activity and lots of people reaching out and lots of people getting accepted offers just in the last couple of weeks. So it seems like the spring market is moving up earlier and earlier each year because people are starting to come out of the woodwork. They're seeing that these interest rates are decreasing and they want to pounce on the market, pounce on an opportunity before the market really starts to heat up in the spring. So that bodes well for anybody that's sitting on the sidelines. Like now is really the time to get your ducks in a row, reach out to your mortgage broker and start to get some rate holds secured. And it's more imperative now than ever to secure some rate holds because the market in terms of interest rates is so volatile because of the new administration in the States. So fixed rates right now are low, but bond yields could move up if the trade tariffs come into effect. So it's really important to secure that rate hold, which will lock in for the next 4 months. And in the meantime, my job is to continue to monitor the market so that if there are any rate specials, then we can pounce on those as well. In terms of people concerned about what's happening with the job market, um, from my experience with my clients, nobody has indicated any concern. However, there is a lot of caution when it comes to choosing which product suits them in terms of a mortgage product, whether it's fixed or variable, because they're very concerned about the volatility with respect to where is prime headed, where are fixed rates headed. So there's a lot more caution, I would say, and a lot more deliberation in terms of choosing the right product. And I think that's going to play out as the months progress once we see whether or not these tariffs kick in, if there's going to be a rescission period or a grace period before they kick in, if there's any deals to be made. So it's a bit of a waiting game. And what's interesting is that in today's Bank of Canada rate announcement, they mentioned twice that they're watching what's going to unfold with respect to tariffs. So the Bank of Canada is cautiously treading lightly. They decreased their overnight lending rate today by a quarter point because inflation's behaving itself. The latest inflation data was at 1.8%, which is lovely. However, that's in part to the GST holiday that we're enjoying at the moment. So the next Bank of Canada announcement is March 12th, I believe. So that's 2 months worth of data that still has to unfold before we see what the bank's next decision is going to be. And obviously, within those next 2 months, we're going to see what happens with tariffs as well.
There's so many things to talk about there because, of course, the Bank of Canada is going to be watching what plays out with the tariffs because the tariffs can be inflationary
Exactly.
um, for us and for the US, of course. It'll be inflationary for them. And of course, our dollar, right? Like, because it's inflationary if our dollar drops and we continue to decrease rates and perhaps the US doesn't because our economy is much stronger, then our weakening Canadian dollar creates inflation because we import so many US goods. And we talked about this one of the last times that we met, that inflation is still actually a risk. Like even though it is behaving and it's come down significantly from the highs of the past, there are a lot of factors at play here and no one knows exactly how it's all going to transpire. And a lot of it has to do not just with the administration to the south, but our own administration and how this all plays out and who our leadership is and what our leadership decides to do when we actually have a chance to decide that as the people. So therefore, there is a strong chance that inflation can come back and rates could go higher this year, right? I think that's the conversation that you're having.
Absolutely. So right now we're enjoying lower rates than a year ago. Absolutely. But that's not to say they're here to stay.
Right.
They
And
could
so
they could move up.
So give me an example. I know everyone's situation is different. So when we quote rates today, they're very different. If you're doing less than 20% down, more than 20% down, purchase price, value, your job, do you live in the property or not? But let's just average rates, just something to talk about. Like what's the difference between your average 5-year fixed rate now, if that's the product that people are looking at, and a variable rate? Like what's the spread
Yeah.
between?
For fixed rates, for example, depending on whether or not you're insured, putting less than 20% down, or conventional, putting at least 20% down, the spread is anywhere from the high threes to the mid fours for fixed rates, and that's between a 3 year and a 5 year, depending on what you decide to take. For a variable rate, that's going to be floating at about 4.25 to 4.5, um, for insured or conventional. So you can see how now that the prime rate has decreased by a quarter point, variable rates are very close to where you would be if you had chosen a fixed rate mortgage. So you're faced with the decision
Today. If
today.
you face one today, yes. Okay.
Exactly.
Yeah.
So today, if you're taking a variable rate, if the Bank of Canada continues to decrease their overnight lending rate and then consequently prime continues to decrease by a quarter point or half a point, then you're going to be floating at a rate that's beneath a fixed rate. So it's very enticing to want to choose a variable rate, but it all depends on your own personal risk tolerance and what you feel comfortable doing. So if you are worried about, is the Bank of Canada going to actually increase their overnight lending rate later this year because inflation is running amok or because of whatever, then perhaps a variable rate mortgage is not the best choice for yourself. Perhaps you want to know exactly what your payments are going to be for the next 2, 3, 4, 5 years. Or perhaps you're thinking, well, I'm going to be buying a place and then in 2 or 3 years, I'm going to actually move up the property ladder and I want to potentially keep this place as a rental or I want to purchase a rental. So it's a very specific conversation that we can't, it's not one brush stroke that's going to fit all, right? So it's a very delicate conversation where we really look at your own personal goals, your risk tolerance, what you feel comfortable with, what your outlook looks like for the next few years. It's intricate.
Got it. Yeah, well, there's pros and cons, right? Because the variable, I mean, it's kind of hanging around the same rate as a fixed, but it sounds like in some circumstances you can get a fixed rate lower than a variable rate right now, and then you're banking on the variable continuing to go down, which it means that the Bank of Canada continues to decrease rates, and they only do that if the economy is not performing, which that could totally happen with these tariffs, right? Like if we have issues with the administration and our economy, then the rates can continue to go down. But that in turn can also create inflation. So it's such an interesting dynamic there.
So many
So
factors at play, for
so
sure.
many factors. So really it's interesting. Like for people that like you said, I think it is a 100% like you need to go secure your rates right now because you don't know what you're going to do yet, but get that conversation started because obviously there is a lot to consider. Pros and cons of either choice, the stability over the next, 3 to 5 years with a fixed rate if you're entering the housing market. And like, what if things go really well for us? What if we, this country all of a sudden just turns around and becomes an economic superpower, which it completely has the ability to be and can prosper for all. And then the economy is a humming, right? Like, and that can create inflation too, but things are good and strong and, real estate values go up and all of those things happen. Or you can ride the variable because you think it might go the other way and payments can get cheaper because we might just continue to muddle along like we have for the last 10 years. Such an interesting time. But you need a place to live. People need a place to live. And so we've got to make the best decision, which means you have to get on this planning and this education early to understand what are your potential future plans, like Jackie was saying, so that you can factor those in because each type of mortgage obviously impacts your next move and you want to take the right one for that next potential move and for planning purposes. I think this is awesome. And I think this is a great opportunity for people to reach out to you, whoever they're working with. Obviously, there's actually all those people with the renewals coming up. Actually, I don't want to forget about them because they're a
Oh,
big segment. I feel like we've kind of seen this though. Like last year was a very the beginning of the people that have already been in the market are renewing into this new rate environment. The market didn't go to hell in a handbasket. I mean, obviously it changed. There's more inventory. There's some downward pressure on pricing, but like prices are still kind of bumping along all-time highs in most respects, depending on the product. Obviously, one-bedroom condos downtown, a little bit different. So we're going to see a lot more people coming into the renewal this year and next. What are the strategies that are working for those people with existing mortgages coming into a much higher rate environment if you haven't spoken to them already and they're probably thinking about and getting nervous about what's next for them?
Yeah, I think what's great is that a lot of my clients and I are having conversations quite early on, like 6 months before their renewal date, which is awesome because it gives us an opportunity to check in, see if there's any kind of housekeeping that they'd like to do, if they want to consolidate any debt, or if they're concerned about payment shock when when they're choosing their next mortgage term, to make sure that they're actually comfortable with those payments. Quite often clients are getting renewal letters from their lender that are only reaching out to them at the last minute in the hopes that it's too late for them to switch lenders. So we're being super proactive and getting those conversations started early. What's interesting is that a lot of people are concerned about, I'm worried about payment shock and I don't know how I'm going to make my payments because I'm coming out of these super low interest rates. And then they get offered these renewal rates from their lenders, but they don't follow up with the question, well, what's my payment going to be? So it's a really important conversation because you might be offered a renewal rate by your lender, but you have to make sure that the dollars and cents make sense for you because you're being offered these rates and the rates can be substantially, or your payments can be substantially higher than what you're used to. So we have the ability to extend your amortization so that we can lower those rates. And more often than not, your existing lender, if you choose to extend your amortization, will not offer you as competitive interest rates. So, for example, I have clients right now that are renewing in the middle of February, and their payments with their existing lender, if they chose to renew with that lender, are $800 more per month, which that's a lot of money if you're a middle income earner, and it's
It's
hard
just
to
a
come.
dollar money period. Like if you're
It's a
like, you
lot of
mean they're
money.
increasing by $800 a month, right?
Yes.
Yeah.
And that's over
Yeah.
and above your groceries that for the last couple years have been sky high. So
Yeah.
everything is more expensive now. Our job is to help mitigate payment shock and to discuss options with you in terms of extending your amortization. And if you're carrying some debt, like credit card debt, line of credit debt, car loans, all this debt over and above your higher cost of living because of inflation, grocery prices have gone up. I haven't really seen them come down. So even though inflation's come down, my raspberries are not cheaper at the grocery store. So my goal is to help you improve your overall cash flow. So at renewal, and even if you're not at renewal, if you're midway through your term, it's worth having a conversation to see if we can improve your cash flow. So there's lots to discuss. It's not as simple as, oh, well, my bank's giving me this rate. That's great your bank's giving you that rate, but what is it going to cost you each month? And so it's an opportunity to do a financial check-in, like a wellness check-in, to make sure that you're reaching your goals because having a mortgage is great, but at the end of the day, I would really like to be on your team to help you be financially successful. So we can do a holistic approach where we're looking at, are you investing in your TFSA? Do you have your kids' RESPs topped up to the max? Are you considering purchasing a rental property so that you're helping your kids have a place when they're ready to enter the market? All of these things go hand in hand. So it's not as simple as what's your best rate and am I going to freak out with the payment?
Yeah, no, I mean, I think what you're saying is that banks are going to offer existing mortgagees new interest rates, and they're going to try to obviously retain your business. But I think there's a few things that have happened, like the not just the extended amortization, but the fact that you don't need to be stress test, I believe, if you're going to
Mm.
explore new lenders. And then, of course, what you're talking about is restructuring the deal. So the rate is only one part of the package. You have to go, what's the rate? What's the amortization? What other debts are you carrying? Is there a way to repackage this so that when you add all your monthly payments all together, can you get it as low as it can be in this higher rate environment? Because the fact is that like it's going to be more expensive. So who can help you restructure your entire financial plate to make it the most affordable? And rate is only one small piece of that, right?
You hit the nail on the head. Can you just be my spokesperson for all?
But But I just actually do want to come back to like we're in a new environment. I think it was only in November where OSFI allowed you to no longer have to be stress tested to shop around for a new mortgage. Is that right?
Yes. So if you have a standalone mortgage, you can switch lenders and there's no stress test anymore. So you don't have to qualify the mortgage at the contract rate plus 2%. So that's huge for some clients because right now, if you think, okay, rates are around four, four and a quarter, four and a half, you have to qualify at six, six and a quarter, 6.5%. That's a huge stressor for some people. So if you can mitigate that altogether, that's huge. It just provides consumers more choice, and at the end of the day, if there's more choice, there's more competition, the consumer benefits the most. You want to have access to as much choice as possible so that you feel comfortable and confident making the right financial decision for you and your family.
Totally. And so are you seeing lenders get really aggressive trying to retain business or attracting new business from other lenders in these renewal cases?
It's been a bit of a mixed bag. Some lenders are super aggressive with one client and then they couldn't care less about the next client. It's kind of strange. I think it's an interesting time that we're in. Lenders are always hungry for business, but as to how hungry they are, I think it really depends on the client and also what the client brings to the table. If there's an opportunity for a lender to be able to sell a client more products, they might be more inclined to be more aggressive to either retain that client or to bring them onto their books. It's a bit of a mixed bag. There's no clear indication that, yeah, they're certainly gonna stick their claws into the clients and hope they never leave.
Okay, well, it sounds like you don't know what anyone has to offer you besides your renewal letter unless you speak to a mortgage broker who has the ability to speak to different lenders. Because, of course, when you go to your bank, the bank can only sell you their product under their terms, and they are not going to offer you, if you're at TD, they're not going to offer you Scotia or any of the other lenders that exist out there. So you definitely need to speak to a broker, and that doesn't cost you anything. So that's great. So now's the time to get in touch and review your file and see what's going on. So hope you enjoyed this mortgage check-in and all this information. If you have any questions, make sure you schedule a time for a confidential call about your specific scenario. We'd love to hear from you. I'm Christine Kopr with Sotheby's Realty in Vancouver, BC. I have,
Jackie Zerbe from Verico Total Mortgage.
and we're going to be signing off for today. Thanks so much for joining us. Look forward to hearing from you.